I believe MicroStrategy will be one of the largest companies in America because of its Bitcoin holdings. So it's about 100 billion market cap today, 15 billion of debt, so 115. If Bitcoin goes to 2 million, then that's going to be a $2 trillion company. And it's because of its holding of Bitcoin, no different than an oil company. I think Ethereum can reach 60,000 per token in that world. And that would proportionally benefit the DATs because Ethereum's around 4,500 today. So a 15 times increase plus the NAV expansion. So there would be a lot of upside in the existing Ethereum treasury stocks in that world. And many would become multiple hundreds of billions of dollars of market cap.
Tom Lee doesn't see crypto as a side bet. He sees it as the foundation of the next financial era. As chairman of BitMine Immersion Technologies, he says the company isn't trying to grow just for the sake of size. Its entire mission is to increase Ethereum holdings per share, ensuring that shareholders, not lenders, capture the upside when the market shifts. In his words, the goal isn't expansion, it's precision. Every transaction has to raise the intrinsic value of each share measured in ETH, not just inflate balance sheets in dollar terms. Lee draws a direct comparison to MicroStrategy's Bitcoin playbook. Michael Saylor turned his software company into a Bitcoin treasury, and the market rewarded that vision. If Bitcoin ever hits $2 million, MicroStrategy's valuation could soar past $2 trillion. Apply that same thinking to Ethereum, and a $60,000 ETH would make companies holding it, like BitMine, worth hundreds of billions. It's not fantasy, Lee says. It's math once you accept crypto as the new monetary base. Beyond balance sheets, Lee's eyes are on tokenization, the process of converting real-world assets like Tesla or Nvidia stock into blockchain-based tokens. That, he believes, will make financial markets radically more transparent. Investors could instantly see what's priced in, how much risk each factor carries, and hedge with unmatched precision. It's a system driven by data, not emotion, where market moves reflect actual information instead of speculation. In Lee's view, this isn't about replacing the old system, it's about evolving it. Crypto isn't the fringe anymore. It's becoming the backbone of how value, risk, and ownership will be measured in the years ahead. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Well, I worked at JP Morgan during GFC, and Jamie Dimon was the guiding light, really the company that survived and prospered and really grew because of the GFC. And I know the first principle is a fortress balance sheet. And that's also BitMine's view that we want to have a fortress balance sheet. So it is a straight equity company and always running cash. I think we've always reported every weekly update somewhere between $400 and $800 million of cash. Because of our size, our liquidity and our volatility, because we have 120 vol stock, which is twice the volatility of MicroStrategy. Every bank has offered us the American Express black card of solutions to raise capital. And I've had zero interest in anything but the simplest and most understandable capital structure. So I think it's first principle of BitMine to be straight and simple as possible until the moment changes. But today, debt is not appealing, or having convertible instruments is not appealing for exactly reasons described. I don't want our capital structure to compete with equity holders in the event of a downturn. There was a chance, an opportunity, and this is, I'm not saying we have been looking at anything, but let's say that our ETH per share is around 50 or something, and there's a chance to grow it to 75 in one transaction. So a highly accretive transaction that is a step function raise in the concentration per share, that's appealing because that would be very good for shareholders to grow the Ethereum holdings per share. So it's not a horizontal transaction because a merger with many would become multiple hundreds of billions of dollars of market cap, either at a discount. That's another way to grow concentration, but the idea is not just to be bigger in size, but it's the per share benefit rising. That's the only thing I'd be interested in without incurring or hurting future ability to raise capital or killing future volatility or burdening the company with a pure debt structure. Stats fundamentally trade off the value of the underlying. And so moving it to 24/7 is just a convenience transaction. It's not transformational because it doesn't unlock anything new. But tokenizing an NVIDIA or a Tesla is very appealing. Kathy and I have talked about this in the past, that the real value and the unlock of a tokenized NVIDIA is that we can do a factor bet. We can then see what's priced in for their Blackwell chip sales or their China sales, because now you take NVIDIA's price and you've broken it into tokenized components. And then you can use a prediction market to hedge yourself. So, Fed's replaced, or the Fed does a surprise hike. I can hedge a tokenized equity that way. The issuer has huge transparency. NVIDIA now knows what's priced in for its Blackwell chip sales, its China sales, and they can therefore work with a lot less, hey, what's priced in our stock? They know exactly what's priced in. So I think tokenized equities is a huge unlock, and it's useful for investors and for issuers. And of course, moves us away from quarterly earnings too. I believe MicroStrategy will be one of the largest companies in America because of its Bitcoin holdings. So it's about 100 billion market cap today, 15 billion of debt, so 115. If Bitcoin goes to 2 million, then that's going to be a $2 trillion company. And it's because of its holding of Bitcoin, no different than an oil company. I think Ethereum can reach 60,000 per token in that world. And that would proportionally benefit the DATs because Ethereum's around 4,500 today. So a 15 times increase plus the NAV expansion. So there would be a lot of upside in the existing Ethereum treasury stocks in that world. And many would become multiple hundreds of billions of dollars of market cap.
Tom Lee draws a sharp comparison between BitMine and MicroStrategy, highlighting how passive index funds have allowed MicroStrategy to consistently trade above its net asset value. That, he says, is the power of institutional positioning. BitMine is earlier in that cycle, with maybe 10 major institutions currently involved, but Lee expects that number to grow rapidly as funds begin deciding how to gain exposure to Ethereum-focused companies. Once index inclusion and ETF strategies start factoring in crypto treasury firms, he believes the market will reprice BitMine the same way it did MicroStrategy. Lee explains that because Ethereum isn't just a digital asset but a functioning smart contract network, BitMine operates more like a financial intermediary than a tech company. That distinction, he argues, justifies a valuation above book value. Even without taking on debt or leverage, Ethereum staking could generate roughly $400 million a year in pre-tax income, a stream that behaves more like yield from a financial institution than profit from a mining firm. He closes with perspective. The two biggest banks in the world today are Tether and JP Morgan. JP Morgan trades at more than twice its tangible book value, yet needs hundreds of thousands of employees. BitMine, he says, could match that efficiency digitally. Let's get back to the interview.
So there's power law at work, which is, there is a level where if an entity owns too much of a network, they actually have a negative effect because they're crowding out innovation. We spoke with few researchers, including Fundstrat, and then folks like Jeffrey Kendricks at Standard Charter. 10% is actually still an acceptable level, because if you think about even in any competitive world, if someone has 10% of a system, they aren't in control of it. There's, I don't know if you remember the Herschel Herfindahl HHI index. And if you run that calculation, especially with 70 DATs, and then in DeFi, it's not a concentrated market. It would still be considered highly competitive. So I think up to 12 million Ethereum tokens isn't crowding, and that's double BitMine's target. Besides BitMine, however, as you know, other crypto treasuries have not even been able to secure 1% of ETH. And part of it is that you need the public to provide you the trust through the velocity and trading volume of the stock in order to get there. So I think that there isn't going to be DATs controlling 50% of the Ethereum network. BitMine and MicroStrategy will soon be Russell 1000 constituents. MicroStrategy already is. So that opens up to passive index flows, because that means now 1,700 large cap managers now have to make a decision on whether to overweight or underweight the 480th largest company in America. And that's why BitMine, I think, could actually have accelerating flows next year. The passive index flow is why MicroStrategy has held onto it's a portion of its NAV premium.
We don't pay attention to indexes, so I've never thought about this. This is quite illuminating, Tom.
Yeah, imagine this. If you look at the cap table of BitMine today, maybe there's 10 institutions, but then there's going to be 1,700 that have to decide whether they want to underweight. But equally important, as you know, Ethereum, because it's a smart contract platform, and then the role we're playing within both the community and with the rails, you can see us that we look more like a financial intermediary, which by definition is a bank. And so we should trade at a premium to book value. And there is an ability to add light touch, not lightly regulated operating businesses that don't consume capital. And the ETH staking, will generate even just on the current ETH, close to 400 million of pre-tax net income with zero debt on the company. I think I might bookend two companies and then we can put everybody somewhere on the curve. But the two largest banks in the world now are Tether and JP Morgan. And JP Morgan trades at, I believe, over two times tangible book.
Okay.
But they have 330,000 employees, which is their largest expense. And in an AI and blockchain world, they may go down to 20,000 employees. So the JP Morgan likely re-rates in the future towards being a technology stock. Now, Tether's tangible book is quite low, and it has a vastly more profitable business because it is very light employee intensive. The employee intensity is low. So if that price to book, let's say, is a exponent, a log function of JP Morgan's 2 to 3 times, which is rising, then that means that crypto treasuries shouldn't trade at 2 times NAV that are involved in the ecosystem. So in other words, the Bitcoin treasuries are designed to be inert. MicroStrategy is an inert holder of Bitcoin, but BitMine is active and engaged in the Ethereum ecosystem. So it'll trade more like a financial intermediary, but JP Morgan and Tether are the bookends. I think that's why that multiple of the ETH holdings will actually rise over time for the winner take most.
Something big is shifting beneath the surface of finance, and Tom Lee's perspective makes it clear. It's not about speculation anymore, it's about infrastructure. The rails of the next financial system are being laid in code, not concrete. What BitMine is doing with Ethereum isn't a tech experiment. It's a structural bet on how value will be stored, measured, and multiplied in a digital economy. The way companies once held oil, gold, or cash reserves, they're now beginning to hold digital assets that produce yield, liquidity, and transparency all at once. It's a playbook built for a world where speed and verifiability matter more than tradition. As blockchain becomes the accounting language of global capital, the line between finance and technology is dissolving. What Lee is describing isn't the future of crypto. It's the gradual digitization of everything that used to sit behind vault doors and balance sheets. The real question now is whether traditional markets will adapt fast enough, or if by the time they do, the real leverage will already belong to those who built their foundations on code instead of paper. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.